Right now, as you are watching this video, Bitcoin is sitting inside a trap. Not a metaphor, not a theory, an actual, documented, data-verified trap with a specific dollar amount attached to it. On one side of this trap, according to CoinGlass data published today, if Bitcoin falls below $65,668, it will trigger $1.679 billion in long liquidations across every major centralized exchange simultaneously. That is not a prediction. That is not an estimate. That is a live heat map showing exactly where the leverage is clustered, exactly where the stop losses are stacked, and exactly what happens to the price when that level breaks. $1.679 billion in forced selling, all triggered by a single price level less than $3,000 below where we are right now. And on the other side of this exact same trap, if Bitcoin breaks above $72,454, it triggers $742 million in short liquidations. Traders who bet against Bitcoin getting forced to buy back their positions all at the same time, creating a violent short squeeze that could send the price rocketing in a matter of hours. Bitcoin is sitting directly between these two explosions right now. And what I am going to show you in this video is something that almost nobody covering this market today is talking about, because while everyone is focused on Iran, oil prices, and the geopolitical headlines, the actual story is happening in the derivatives data, in the on-chain signals, and in a specific set of indicators that are lining up in a way I have not seen since the bottom of the last bear market. Stay with me through this entire video. Because the information I am about to give you is the difference between the people who look back at this week as the moment they should have acted and the people who actually did. First, let me give you the complete picture of where we are right now, because you need to understand the full context before any of the specific numbers make sense. Bitcoin's all-time high was $126,199, reached on October 6, 2025. From that peak, Bitcoin has fallen approximately 48%, landing in this current range between $63,000 and $70,000 that is now held for over 3 weeks. The price rallied to $70,044 on Monday, got rejected immediately, and has since been compressing in a tightening range, lower highs since the 70,000 peak, higher lows since the 62,900 floor, exactly the pattern that technical analysts call a symmetrical triangle. And symmetrical triangles, by definition, resolve in one direction with a powerful breakout. The market is coiling. The question that matters, the only question that matters right now, is which direction it breaks. And that is exactly what the data I am about to show you answers. But before I get into the data, I need to say something directly to every single person watching this right now. And I need you to actually hear this, because this might be the most important 30 seconds of this entire video. Right now, while you are watching this, someone you know is about to make the worst financial decision of their life. They are looking at this same chart. They are reading the same Iran headlines. They are seeing the same red candles. And they are about to hit sell. And I am telling you, do not do that. I am not saying this to make you feel better. I am not saying this to be optimistic for the sake of it. I am saying this because the data I am about to show you proves, with specific numbers from live sources published today, that the moment of maximum fear you are feeling right now is precisely, and I mean precisely, the moment that the people on the other side of this trade have been waiting for. Every single time in Bitcoin's history that the fear and greed index dropped to 14, and which is exactly where it is right now, the people who sold at that exact moment handed their coins to the people who are now wealthy. Not because Bitcoin never went lower, sometimes it did, but because the asymmetry at this specific moment in the cycle is so tilted toward reward over the next 3 to 12 months that selling is the one action that guarantees you miss what comes next. So before I show you the $1.679 billion trap, before I show you the short squeeze setup, before I walk you through the 5 signals that are all pointing in the same direction today, understand this first. Panic selling at extreme fear is how retail investors donate their Bitcoin to whales, and I'm not going to let you be the retail investor in this story. Now let's get into the data. Let's start with the CoinGlass liquidation heat map, because this is the most important piece of data in this entire video, and most retail investors never look at it. The liquidation heat map is a live database maintained by CoinGlass that tracks every leverage position across every major centralized exchange, Binance, Bybit, OKX, Bitget, and others. It shows with precision exactly where clusters of long positions and short positions are concentrated and what price levels would trigger their forced liquidation. And what it is showing today is extraordinary. Below $65,668, there is a wall of leveraged long positions that, if the price touches that level, will trigger cascading forced selling totaling $1.679 billion. This is what traders call a liquidation cascade. One position gets liquidated, it pushes the price slightly lower, which liquidates the next position, which pushes the price lower again, which liquidates the next one, and so on in a chain reaction that can move the price down 3 to 5% in minutes with no fundamental catalyst. Just pure mechanical liquidation pressure. $1.679 billion is an enormous number. To put it in context, the entire daily trading volume of Bitcoin across all exchanges is typically around $28 to $30 billion. A $1.679 billion cascade event is roughly 6% of daily volume hitting the market in a single direction over a very short time window. That creates the kind of vertical drop that looks terrifying on a chart and sends people to social media to announce that Bitcoin is going to zero. But here is what makes this situation so fascinating and so different from what most people think is happening. Above $72,454, there is an equally significant cluster of short positions, traders who have bet against Bitcoin and who are currently sitting on positions that will be force closed if the price rises to that level. When short positions get force closed, the trader has to buy Bitcoin at market price to close the trade. That buying pushes the price higher, which triggers more short liquidations, which creates more forced buying, which pushes the price higher again. This is the short squeeze, and the number above that level is $742 million in short liquidations, $742 million in forced buying compressed into a single price trigger point, sitting less than $5,000 above the current price. So here is the situation as it exists in real time today. Bitcoin is at approximately $67,000 to $68,000, $3,000 below it, a $1 billion bomb, $5,000 above it, a $700 million rocket, and the market is watching both levels simultaneously. The question is not whether one of these events will happen. One of them almost certainly will. The question is which one happens first, and the answer to that question is what I am going to walk you through right now. There are 5 signals that I look at to understand directional bias in a setup like this. And today, right now, on March 3rd, 2026, all 5 of these signals are pointing in the same direction. I'm going to give them to you one by one because each one on its own is interesting, but all 5 together form a picture that is very difficult to argue with. The first signal is the Coinbase Premium Index. This metric, tracked by CryptoQuant, measures the difference between the Bitcoin price on Coinbase, which is the primary exchange for U.S. institutional and retail investors, and the price on Binance, which is the global reference price. When the Coinbase premium is positive, it means U.S. buyers are paying more for Bitcoin than the rest of the world. They want it badly enough to pay a premium. When it is negative, U.S. demand is weak relative to global demand. Today, March 3rd, 2026, the Coinbase Premium Index turned positive for the first time in several weeks. The reading is plus 0.0028%. Small, but the direction matters more than the magnitude. After weeks of negative readings, weeks where U.S. buyers were absent, where institutional demand was pulling back, where the market was dominated by sellers, the Coinbase Premium has flipped green. U.S. buyers are back. They are right now paying above the global market price to acquire Bitcoin. And this is not retail investors panic buying a headline. The Coinbase Premium turning positive is historically associated with institutional accumulation. Family offices, ETF arbitrage desks, corporate treasuries taking positions. When this indicator flips green during a period of maximum fear, it has consistently preceded major price moves to the upside. This is signal number 1. Signal number 2 is the funding rate. The funding rate is the mechanism that keeps perpetual futures contracts in line with the spot price. When the funding rate is positive, long position holders pay short holders, meaning more people are long than short, and the market is bullish leaning. When the funding rate is negative, short holders pay long holders, meaning more people are short than long, and the market is bearish leaning. Right now, the 8-hour average funding rate is negative 0.0008%. This is a deeply negative reading. It means that the majority of leveraged traders in the Bitcoin market right now are short. They have bet against Bitcoin. They are currently paying longs for the privilege of holding their short positions. And here is why this matters more than almost anything else I could show you. Negative funding rates during periods of extreme fear are the exact fingerprint of a market that is positioned for a squeeze. Every time in Bitcoin's recent history where you had simultaneously deeply negative funding rates and Coinbase Premium turning green and extreme fear sentiment, Bitcoin went up, not down. Because the moment there is any catalyst that forces a covering of those shorts, the $742 million in forced buying above $72,454 gets triggered and the price moves violently to the upside. The market is coiled, the spring is compressed. And it is compressed to the short side, which means the energy when it releases fires upward. This is signal number 2. Signal number 3 is the open interest reset. Open interest is the total value of all outstanding derivative positions in Bitcoin. Every futures contract, every perpetual swap, every options contract that has not yet been settled. At Bitcoin's peak in October 2025, when the price was at $126,000, the open interest was $56.6 billion. That was an extraordinary amount of leverage in the system. When price falls from a leveraged extreme, that leverage gets unwound. Positions get liquidated, margin calls get hit, accounts get wiped, and the open interest shrinks. Today, Bitcoin's open interest is $23.6 billion. That is a 58% decline from the peak. In other words, of the $56.6 billion in leveraged bets that existed at the top of this cycle, more than $33 billion have been wiped out. The system has been cleansed. The excessive speculation that built up during the run to 126,000 has been flushed. What you have now is a derivatives market that has been reset to a much lower base, a clean slate with less leverage, less speculative excess, and a much healthier foundation for the next move. This open interest reset is one of the most bullish structural signals in the entire dataset right now because it means the next rally when it comes will not be immediately undermined by over-leveraged positions getting liquidated at every new high. This is signal number 3. Signal number 4 is the ETF flow data from today. U.S. spot crypto ETFs recorded $521.45 million in total net inflows today, March 3, 2026. Bitcoin products alone absorbed $458.2 million of that. Translated into actual Bitcoin, the ETFs bought 6,970 coins today. That number is significant in a way that most people miss. The Bitcoin network currently mines approximately 450 new coins per day after the most recent halving. 6,970 Bitcoin bought in a single day by ETFs alone represents approximately 15.5 days of newly mined supply. In one trading session, institutional investors absorbed more than 2 weeks' worth of all the new Bitcoin that will ever be created. The economics of supply and demand are not complicated. When an entity purchases 15 days of supply in a single day, and that purchasing pace is sustained, or even continues at half that rate, the available supply on exchanges shrinks. Bitcoin's exchange reserves are already at their lowest levels in years. The combination of massive institutional buying and historically low exchange supply creates a structural price pressure that operates completely independently of whatever is happening with Iran or oil prices or geopolitical headlines. The headline story and the on-chain story are telling two completely different things right now. And in my experience, when those two stories diverge this sharply, the on-chain story is the one that predicts where price goes next. This is signal number 4. Signal number 5 is the Van Eck macro bottom thesis, published today by CEO Jan van Eck. Van Eck is one of the most respected names in traditional finance. They have been managing money for decades and were among the first major asset managers to push for a Bitcoin ETF. When their CEO publishes a public macro thesis about Bitcoin, it is not noise. Today, Jan van Eck argued that the current $60,000 to $70,000 zone represents the real cycle reset point. The level that functions as the structural floor for the next phase of Bitcoin's adoption curve. His argument is grounded in the same on-chain data we have been discussing. The MVRV ratio at December 2022 levels, the open interest reset, the long-term holder selling that dropped 87% from February peaks. And his conclusion is that the market is in the final phase of its post-halving correction, not the beginning of a new bear market. This matters not because Van Eck is always right. They are not. What matters is the signal it sends when a firm of this caliber and credibility makes a public bottom call. It tells you where the institutional conversation is happening. And when institutional conviction aligns with on-chain data and derivatives positioning, the direction of that alignment has historically proven correct. This is signal number 5. 5 signals. Coinbase premium green. Negative funding rate. Open interest fully reset. ETFs absorbing 15 days of supply in one day. Van Eck calling a macro bottom. All 5 pointing in the same direction. And yet Bitcoin is sitting below 70,000. And yet the market is still in extreme fear. And yet most of the content you will consume today will be about Iran and oil prices and why Bitcoin might crash to 40,000. I want you to stop right here for a second and ask yourself a question. If the on-chain data is screaming accumulation, if ETFs are buying 15 days of supply in a single session, if the Coinbase premium just turned green for the first time in weeks, if the funding rate means shorts are literally paying money every hour they hold their bet against Bitcoin, then who exactly is selling? Because somebody is selling. Every buy has a seller. And the answer to that question is the most important thing I can tell you about this market. The people selling right now are the people who bought during the euphoria and during the run from 70,000 to 126,000, who have been sitting underwater for months, who have been watching the price bleed week after week, and who have finally reached their psychological breaking point. They are selling not because the fundamental value of Bitcoin has changed. They are selling because the pain of watching their portfolio go down has become unbearable. That is called capitulation. And capitulation is not a sign that the market is going to continue lower forever. Capitulation is what the end of a bear market feels like. It feels terrible precisely because it is designed to shake out every last weak hand before the next move begins. The people on the other side of those capitulation sales, the entities absorbing every single coin that panicked sellers are throwing away right now, are not retail investors. They are BlackRock. They are Fidelity. They are Van Eck. They are the whale wallets that accumulated 270,000 Bitcoin in the past several weeks. They are the institutions that bought $767 million worth of Bitcoin through IBIT in a single day last Monday. They know something the panicking sellers do not know. And you now know it too. So please, before you even think about selling anything right now, understand what you are doing. You are handing your Bitcoin to a billion-dollar institution at the exact moment they have decided it is one of the best buying opportunities of this cycle. Now let me give you the bear case honestly, because I am not here to give you a one-sided picture and I will never do that. The bear case is real. There are 3 legs to it, and they are all legitimate. The first leg is the 65,668 level itself. If Bitcoin breaks below that number on a real candle close, not a wick, a full body close below that level, the $1.679 billion cascade triggers. That cascade could push Bitcoin down to 63,000, then 62,900, which is the February 5th floor. If that floor breaks on a daily close, the next technical supports are at 56,800, then 52,300, and in the worst case scenario, the Fibonacci extensions point toward 47,800. That is the crash side of the 40,000 or 200,000 equation. Specific, data-backed, technically grounded. The second leg of the bear case is the Federal Reserve. The Fed meets March 17th and 18th. Market is pricing 89% probability of no rate cut. If the Iran war drives oil to $100 or higher, inflation expectations rise, and the Fed has to signal a more hawkish stance. Higher rates for longer, potentially even a hike. Risk assets, including Bitcoin, sell off hard. Rate hike environment is historically the most damaging macro backdrop for Bitcoin. The third leg is equity correlation. Bitcoin is still trading with high correlation to the Nasdaq. If U.S. equities continue their decline, and with Japan down 6%, South Korea down 7%, India down 3% today, a sustained global risk-off move could drag Bitcoin below its technical support regardless of what the on-chain data says. That is the complete, honest bear case. 3 real legs. All 3 are possible. None of them can be dismissed. Now here's what determines which scenario plays out. The squeeze scenario or the crash scenario. And it is a single number that I need you to write down right now. 65,668. That is your line in the sand. As long as Bitcoin trades above that number, the $1.679 billion cascade does not trigger. The 5 on-chain signals I showed you stay intact. The pressure on the shorts, who are currently paying to hold their negative funding rate positions, continues building. And every day that passes without the cascade triggering is a day that the squeeze setup becomes more powerful, because the shorts are bleeding money just by staying in their positions, and the institutional buying continues to reduce available supply. But if Bitcoin breaks below 65,668 on a real daily close, the dynamics change completely. The cascade triggers, the floor gets tested at 62,900, and the question becomes whether that floor holds or the deeper bear case levels come into play. This is the setup. This is the trap. And whichever side it resolves on, the move will be violent. The squeeze scenario plays out like this. Bitcoin holds above 65,668 over the next several days. The Iran situation, while serious, does not escalate to the point of oil reaching $100. The FOMC on March 17th and 18th produces a hold with dovish language. Powell signals that rate cuts are still on the table for later in the year, possibly May or June. The combination of dovish Fed language, continued ETF inflows, and the mechanical pressure on shorts from negative funding rates triggers a wave of covering. Price breaks above 68,000, then 69,000, then approaches 70,000. At 70,000, the technical resistance that has capped 3 rallies now has to contend with the fact that there are $742 million in short positions stacked above 72,454. If price breaks through 70,000 with enough momentum, those shorts start getting hit. Forced buying kicks in, the squeeze fires, price jumps to 72, 73, potentially $75,000 to $78,000 in a very short window. And if institutional inflows continue at the pace we have seen this week through the FOMC decision, the scenario that Arthur Hayes projected, Bitcoin at $250,000 in 2026 because the Fed prints money to fund military operations, does not look as impossible as it sounds right now. The macro precedent exists. After the U.S. military actions in June 2025, the Fed shifted toward easier monetary conditions and Bitcoin ran from below 100,000 to 126,000. If that pattern repeats, conflict forces monetary expansion forces Bitcoin rally, then the $200,000 number is not a fantasy. It is a historically grounded scenario that the most credible names in this space are publicly defending. The cascade scenario plays out like this. The macro environment deteriorates faster than the on-chain data can offset it. The Iran conflict extends. Oil hits $100. U.S. inflation data surprises to the upside. The Fed at its March 17th to 18th meeting signals hawkishness rather than dovishness. Equity markets continue to slide. Bitcoin's high correlation to the Nasdaq drags it below 66,000, then 65,700, and then hits 65,668. The cascade triggers. $1.679 billion in forced selling hits the market. Price drops quickly to 63,000, tests the February 5th floor at 62,900. If that floor holds, and Van Eck's bottom thesis and the on-chain data suggest it should, then the flush is actually a gift. It clears the last remaining over-leveraged positions, resets the funding rate to even more extreme negative levels, reduces open interest further, and sets up an even more violent squeeze when the recovery begins. The people who sold at 63,000 hand their coins to the institutions. The institutions absorb them, and the rocket fires from a lower, cleaner base than if the squeeze had happened at current levels. If the floor does not hold and price breaks below 62,900 on a daily close, then 56,000 is the next major support and the deeper bear case levels come into the conversation. But I want you to notice something important about both scenarios. In the squeeze scenario, the direction is obviously up. In the cascade scenario, if the 62,900 floor holds, which the weight of evidence says it should, the long-term direction is also eventually up. The only scenario where the long-term outcome is genuinely bearish is if both 65,668 and 62,900 break on daily candle closes with no recovery. And that scenario requires a significant deterioration in the macro environment that goes well beyond what is currently priced into markets. Here is what I want you to understand about the structure of this market right now, and this is the part that I think most people are missing completely. Open interest collapsed 58% from the peak. That means more than half of all the leverage speculation in this market has been wiped out. The traders who were overexposed got liquidated. The accounts that were taking too much risk got margin called. The excess has been removed. What remains is a market with much lower leverage, much cleaner positioning, and a derivative structure that is now leaning heavily short, meaning the next move up does not have to fight through waves of long liquidations the way it would have at the top. This is the opposite of the conditions that existed at $126,000, when everyone was leveraged long and every dip triggered cascading liquidations on the way down. Now the setup is inverted. The leverage is on the short side. The big move that clears the book now fires upward, not downward, and with 270,000 Bitcoin accumulated by whales, 6,970 Bitcoin bought by ETFs today alone, long-term holders selling down 87%, and the Coinbase premium turning positive for the first time in weeks, the underlying demand is building precisely as the speculative short position grows more extreme. This is the anatomy of a squeeze, and the trigger is sitting at $72,454. Let me bring everything together into the clearest possible picture. Bitcoin is at approximately $68,000. The trap levels are 65,668 on the downside and 72,454 on the upside. 5 independent signals: Coinbase premium positive, funding deeply negative, open interest reset 58%, ETFs buying 15 days of supply today, VanEck calling a macro bottom. All point toward the upside resolution being the higher probability outcome. The bear case requires a specific combination of macro deterioration that is possible but not yet the base case. March 17th and 18th is the catalyst date. The FOMC decision will either confirm the squeeze setup or accelerate the flush. And the single most important number to watch every day between now and that meeting is 65,668. Every day Bitcoin holds above that level, the squeeze probability increases and the cascade probability decreases. I am not going to tell you this is guaranteed. Nothing in markets is guaranteed. I am not going to tell you this is financial advice because it is not. Bitcoin is a highly volatile asset and losses are always possible, and you should never invest more than you are prepared to lose. What I'm going to tell you is this. I have been analyzing this market for a long time. I have seen extreme fear before. I have seen capitulation before. I have seen the exact moment where the retail investor panics and the institutional money quietly steps in. And what is happening right now in the CoinGlass data, in the CryptoQuant on-chain metrics, in the Soso Value ETF flow numbers, in the VanEck public statement published today, looks more like that moment than anything I have seen in this cycle so far. The trap is set. The spring is compressed. One side of this trade is about to be very, very wrong. Now you know exactly what the trap looks like, exactly where both trigger levels are, and exactly what the data is saying about which direction it resolves. What you do with that information is entirely up to you. One last thing before you go. Drop a comment right now and tell me, do you think Bitcoin holds 65,668 and the squeeze fires, or do you think the cascade triggers first? Just type squeeze or cascade in the comments. I read every single one and I will reply to as many as I can, because this community is what makes this channel worth building. And if you want to be here when I cover exactly what happens next, because the resolution of this setup is coming within days, not weeks, make sure you are subscribed and the bell is turned on. I will see you in the next one.